Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hello and welcome to Better System Trader. This is episode number 130, and this is the second episode in what will now be a three-part series on building mean reversion strategies with Cesar Alvarez from Alvarez Quant Trading. And the reason why this is now a three-part series instead of the two we had originally planned is because we received such a huge amount of questions. I think it was probably maybe 6 or maybe it was 8 pages worth of questions. So we've recorded that now, and it's now going to be its own episode. So look out for that as the third episode in the series coming out really soon. We had a lot of great questions in there too, so thanks to everyone who submitted questions. I think you're going to find a lot of value in that. So in the first episode, we discussed the goal of mean reversion trading, how to select a trading universe, a number of effective techniques to measuring mean reversion, and also how to combine indicators to identify better quality trades. Now, if you haven't listened to that episode yet, you should go back and check out that one first. In the second episode in the mean reversion series, we're going to continue on a little bit more about entries first, including how to classify market conditions and adjust mean reversion strategies to the current market. Cesar is also going to share some tips to choosing trades with a higher probability of success when you have more trades than your account can take. He's also going to explain how the maximum number of positions you trade affects the role of luck on trading results and how to produce more reliable results instead, and also why it can be a good idea to have different strategies that enter at market and on limit orders instead of just one or the other. Then we're also going to discuss exits, including the impact of stops on returns and why they don't often protect you from the really big losses. And we're also going to discuss implementing multiple exits, what works best in mean reversion and what to avoid, and how to test exit combinations. Plus, we cover so much more than that, so it's another value-packed episode with Cesar on mean reversion, so let's get straight into it now. Hi Cesar, welcome back again. It's great to have you here for this second part in the mean reversion series.
Yeah, I'm glad to be here, and I'm excited to finish the discussion on mean reversion.
Yeah, so if we just do a quick little review of what we discussed in the first session, just so that jog people's memory a little bit. So we initially started talking about the benefits and the challenges of mean reversion and the types of goals that you're aiming to achieve when you're looking to build mean reversion strategies. And then we had a discussion about the trading universe, and we talked about loads of different ways to measure mean reversion. You discussed a lot of different techniques that we can use there, so that was really interesting. And then we talked a little bit more about the entries and the filters. So I think today we're going to continue on a little bit more with the entries before we move into the other aspects of mean reversion trading.
Yes, that's correct.
Yeah. Okay, so did you want to start with market regimes?
Yes. So one common thing I think is an error that a lot of people do is they try to make a strategy that works in all market types. And what I mean by that is a strategy that works both in bear or bull markets, or a strategy that works both in high volatile markets and no volatility markets. I believe it's really difficult to do those type of strategies. So one thing I tend to do in most of my strategies is to have a market regime, meaning, this strategy is built for a bear market, maybe a bear or bull market, and I do something simply as the 200-day moving average on the SPY, or it could be a strategy that it trades just high volatility environment and something like, only when the VIX is above 20 will I trade the strategy, or only when the VIX is below 15 will I trade the strategy. Or you can also measure volatility based on the historical volatility of the spiders. So those are different ways of adding market regimes. I think it makes it a lot easier as opposed to trying to make a strategy that works well in both bear and bull markets. Another thing that you can use the market regime filter for is to change your strategy. Maybe you do want to change both. So maybe during a bull market, you have loose parameters and and you get in a lot easier. But in a bear market, you make your parameters much tighter. So you look for a mean reversion instead of, let's say, RSI being less than 10. Now you're looking for the RSI less than 1 to be an entry and something like that. So just changing your parameters depending whether you're in a bull market or a bear market or a high volatility market, a low volatility market. Or, of course, you can always just be in cash. I know a lot of people don't like being in cash, but, cash is really good when when everybody else is losing money and the markets are losing money. Those are how I tend to use market regimes on that front there.
So are they the main ways you classify market regimes is basically trending or not trending and volatility? Is there any other kind of things that you look at?
Those are my two primary. Is volatility based. I wouldn't say trending, but more, are we above the 200-day moving average versus being below? For me, trending more means maybe you do, to do trending, I would do something like maybe a dual moving average, the 50 over the 200, kind of like that. But I guess I tend to keep it quite simple. Just saying, if you're above the 200 or below the 200. And then, of course, you can combine them. If you really want to have four market conditions, you can do, a volatile bull market versus a quiet bull market, and, a volatile bear market versus a quiet bear, which usually doesn't exist. So, that's also another very popular thing to do. But I think just two regimes is enough.
Yeah. So when you're looking at the volatility regime, how far back are you looking? Because mean reversion trades typically can only last perhaps a few days. So how far back do you look to kind of get a judge of the market regime?
Yeah, I typically look back. I'll use 100-day historical volatility often as my volatility measure. I'll do that on the SPY or the SPX index. Or you could always do it also on the VIX, like I said. But then I would do something like a moving average on the VIX, just because the VIX can move so much. If I were to use the VIX as my volatility regime.
Yeah, and are you looking for a fixed threshold, or do you try and take into account the recent volatility as well, and look at ratios and things like that?
I tend just to look at a fixed number for the volatility. So both either the VIX or the doing historical volatility on the spiders. Typically when I use values, they're typically in the 18 to 22 range. It's both for the VIX and the historical volatility. Both of those seem to be a good cutoff point when to decide to be in one, a volatile market or not in a volatile market. But you can look, you can say, it's, the current volatility is in the top half of the last, 3 years or whatever time frame. That's another way of looking at it.
Yeah. So when you're looking at the regime, are you assessing the instrument on its own or the index as well, or a combination?
I'm just using the index itself. I don't do it on the traded instruments. I don't do it on the individual stocks. I do it. This is more of a market regime, so I'll do it only on the index itself, not on the individual stocks.
Right. Okay. So that doesn't really concern you if the index is above the 200, but the actual instrument isn't.
Right. Well, yeah, it could be part of my original filters that we discussed on the first episode. But if it's not, I'm not that concerned.
Yeah, I think actually one of the filters you mentioned in our last chat was the ADX. Have you tried using that as a market regime filter?
I did. Oh my goodness, probably 10 years ago, and for whatever reason, didn't decide to go with it. I've not looked at it in a long time. I got a friend of mine who runs a small hedge fund that I believe, at least was using that. I don't know if he's still using the ADX as a regime indicator. He was having good success with it about a decade ago.
Right. Okay.
But I don't know if he's still using it or not.
Yeah. Now, you already touched on this a little bit about the adjusting the setups for loose versus stringent based on regime, but how can that actually be? Can you give us a bit more information on how these strategies can be adapted depending on the different types of regimes that we may see?
Right. I mean, that tends to be my, I'm going to pick on, let's say we have our two regimes are bear and a bull market. So, I developed this strategy for a bull market. And then for a bear market, I noticed, instead of, maybe let's just say I'm using the 2 period RSIs less than 10. And I say, I want my steps to be much more pulled back and gives me much better chance that they'll actually bounce. So I'll say a 2 period RSI is less than 1. I may also look at other, usually I'm using more than one measure for mean reversion. So, if I was also using down days, let's say I was in a bull market, I was using, the stock also has to be down 2 days in a row. Maybe in a bear market, I say it's got to be down 4 days in a row and also be 2 period RSI less than 1. So those are the kinds of things I do. Another thing that I didn't mention I also do in one strategy I'm doing is during a bear market, I'll cut my position sizing in half. So I still use the same. I use a different set of parameters. So I use more stringent parameters, and I cut my position sizing in half. So that's another way of just doing with two different regimes.
Yeah. Okay. Now, so I trade mean reversion strategies on the ASX stocks, and sometimes you can get a lot of signals come through all at once, depending on what the market is doing, and you may not have enough account size to take all those trades at once. So, what do you do about when you get a lot of signals at once? Do you rank them somehow?
Yeah, so I mean, at the end of the day, you got to figure out which ones are giving you the best, returns. The most common ways I use the 100-day historical volatility to rank. So I'll prefer higher volatile stocks over lower. I'll look at the recent returns. So I'll look at, let's say, a 3 or 5 day return, and I look for stocks that have dropped the most over the last 3 or 5 days. And also, you can use your mean reversion. So if you're using something like RSI or Bollinger Band or a stretch for the moving average, you can prefer the ones that have been stretched out the most, the lower RSI, the one that's farther from the moving average, the one that's the percent B that's smaller. So those kinds of things are the ones I prefer. 90% of the time, I end up with using the 100-day historical volatility. That seems to work best for me. I want the stock that's bouncing around the most. That's the likely one's going to give me the biggest return.
Yeah, but I guess then that kind of impacts your position sizing as well, because you're looking at the I guess depending how your position size, obviously, but if you're going for the more volatile ones, that can impact your position size. So how do you take that into account?
Yeah, so position sizing is interesting. There are two general ways of doing the position sizing, I'd say, that most people do. One is a fixed percentage. So if I got a $100,000 portfolio, and I want to trade, let's say 10% per position. So I've got max out of 10 positions, very simple, nothing involved. It's just, straightforward. Doesn't matter how volatile your stock is. Doesn't matter how, what price your stock is or anything like that. You just do 10%. That is my preferred method. And I'll explain why in just a minute. The other one is volatility based, or in a sense of, depending on how volatile a stock is, more volatile stocks, you end up, sizing smaller because, they can move more, you can potentially lose more. The reason I don't do anything volatility based is in most of my research, I find that if it adds anything, it adds very little, to the total returns or to the drawdowns. And I tend to be simple. If I'm not getting a bang for my buck for adding something more complex, I'll sit with something simple. And this, doing the fixed percentage is just much simpler. I tend to get better returns for my strategies that way. And that also helps in a sense when, for my ranking, my higher volatility stocks, then I'm in and they tend to do better. So that's just the way I do my position sizing.
Yeah. Okay. So if you're looking at, say, I think you just said 10% of account size as a fixed percentage, then do you kind of have a maximum number of positions that you're willing to take to keep the portfolio risk in check? Yeah.
So this is where it gets very interesting. I mean, so depending on your strategy, you may say, I want to do 10% per position, or you may say, I want to do 5% per position. That would be equivalent to having up to 20 positions. Or you could be really aggressive and say, I want to do 20% per position, which is the equivalent of doing a maximum of 5 positions. In general, what happens is as you concentrate down and you have more position size, your return will go up along with your drawdowns. And a lot of people get drawn to having, 5 positions only. I have a trader friend of mine that really kind of gets drawn to the smaller number of positions. But the problem you have when you get to smaller positions is you are now at more of the whim of luck. And what I mean by that is if you get a good trade or a bad trade with 5 positions, it's going to have a much more larger impact than if you had, let's say, 20 positions at 5% apiece. So, your results can be dramatically different from another person trading almost exact same thing. But because you either got lucky and, got a stock that went up 100% or got unlucky and got a stock that went down 90%, your returns have now been drastically changed. So that is something one needs to be careful with. And also what happens is when you've done optimizations with 5 positions, you're also tending to look at the strategies that got lucky. And you're more likely to pick a strategy that just got lucky during your backtest period. So So, that's, I think, if you're at 20 positions or 5% each, you're less at the whim of luck, which, as most traders don't want to admit, but there's still a lot of luck in our trading.
Yeah. That's an interesting point to make, to consider that. So how many positions do you think is too much? Like, there must be some kind of level where the efficiency is at its maximum, and then it becomes
really?
Yeah.
Yeah, it really depends on your strategy and your signals. Usually I find between 15 and 20 starting to push it on just having too much. And it also becomes an execution, unless you've got some sort of semi-automated or automated way of placing orders. Placing up to 20 orders a day can get really tedious and very error prone.
Yeah.
So, I usually tend to limit, anything in the 15 to 20. And personally, usually I do between 10 and 12 is my normal number of positions. Or if I'm doing 5, then I will just trade a much smaller portfolio, because knowing that I am at the whim of luck a lot more.
Yep. And what about market regimes? Do you ever look into adjusting the number of positions based on the regime?
Actually, I've never done a look at that to try that. That's a great idea, but something I've never tested before. I'll have to write that one down.
All right, cool. Well, how about we talk a little bit more about entries? So once you have a setup, do you look to enter on the open of the next bar or at a limit, or how do you actually manage that?
Yeah, so we've spent a lot of time talking about our setups, and we're finally now going to be entering our positions. I do both, actually. My current strategies that I'm trading, I got 2 mean reversion strategies I'm trading, and one of them I trade at the open, and one I trade on limits such that the stock needs to sell off further down intraday. Both of them have their advantages and disadvantages. They're trading at the open. It's nice because you're going to get that position. It's the bad part about trading at the open is you tend to be, you have to deal with slippage. Whether you enter a market on open order or you do some sort of TWAP order or you enter a few minutes after the market opens, there's a possibility of slippage there. So, that's the bad part about using that. Using a limit entry, so let's say you say, common thing I do is, I enter, let's say 2% below the previous day's close. You have no guarantee the stock's going to trade down that low. It may open up exactly at the previous day's price and then just take off, and I've seen quite a few stocks that I place limit orders, does that for me. The advantage is, though, is if you get filled, you know exactly what the price you're going to get filled at, which is also, you're not going to have any negative slippage at all, which is great with that. On a very, very rare case, my price will get touched, but I won't be, either I'll get a partial fill or no fill because there just weren't enough shares at that price. But that does not happen that frequently. I'm always quite surprised how infrequent that happens. And from experience, getting filled at the low price of the day tends to be a bad omen. I don't know why. Even though it feels really good, usually what happens is the next day, the stock ends up going down a lot.
Yeah. In your research, have you found that do you get better quality trades by using limits or on the open, or is it kind of mixed depending on the strategy?
It's mixed on a strategy. And it also depends on what you're looking for, in a sense, what your definition of better quality is. You tend to get bigger returns and and a higher percent correct entering on the limit. But the problem is you get fewer other trades. So it's one of those, you have less opportunities. And sometimes having more opportunities is better than having, better opportunities that are less. So that's why I personally trade 2 mean reversion strategies, one that trades at the open and one that trades on limits. So this way I kind of balance out those 2 things.
Yeah, okay. And when you're looking at a limit entry, you just mentioned percentage there, but do you ever take into account like a volatility using an ATR?
I laugh because it's going to be my same song and dance I've given probably 3 or 4 times already. I've looked at that. I have not seen any increase in the returns that makes it worthwhile to add the complexity. I have another friend of mine who we were just talking and developing a strategy, and he went with the adding the volatility to adjust his limits, and he trades quite well, and it's also a matter of personality. It's a matter of deciding if you feel more comfortable saying, you know what, I like trading or I like the volatility-based limit, it just makes me feel better. Well, that's a good reason to do it. It may be a little bit more complex, but adding a rule that will likely can make you continue to trade the strategy is a great rule, in my opinion.
Yeah. Now, what about scaling into trades? Because sometimes mean reversion trades, you can get setups in consecutive days. So what do you look at? How do you manage that?
Yeah, so scaling in is an interesting thing. So I personally don't do any scaling in. I have found in general what scaling in, by scaling in, normally what I mean is I get into the stock and then the next day I get another signal or it closes down, or there's, you have multiple rules for deciding when to potentially scale into a stock. The typical rule that I look at is, the stock closes below my entry price, I'll think about scaling in. Now, the reason I don't scale in is I tend to find that the overall returns are less when I use some sort of scaling in rule. There's one advantage of scaling in that people that I know who do scaling in is it increases your percent correct. And so if you're the type of person that likes to see a high percent correct, and I've seen strategies in the 70s to low 80s percent correct using scaling in on mean reversion, that's a great thing to do. Again, your returns will probably be less overall, even though your percent correct is higher. But this is back to what I just finished saying. If that high percent correct means that you're more likely to continue to trade in strategy when things go poorly, you know what? That's a good rule to add. But for personally, I don't use any scaling in any of my strategies.
Yeah. Okay. Well, what if you've got a setup and you've put in a limit order that doesn't get hit on the day, and then you get another setup the next day? Do you factor the previous day into it, or you don't care?
Well, in that particular case, if I get a setup, I put in the limit order, I don't get filled, and then the next day I get another setup, for the same stock, I will place another limit order. That to me is not scaling in. It's just that first trade never happened, so I'm still trying to get into the trade.
Yeah. All right, so now we're in the trades. How do we get out? There's a lot of different techniques for stops and exits. So do you want to tell us some of the techniques that you like to use?
Sure. Yeah. I'll tell you some of the techniques that I use and some techniques that are common and why I don't use them. The most common one is just using your indicator. Whatever indicator, mean reversion indicator you use to get in, you use it to get out. So if I use the a stretch below the moving average to, let's say I got in when the stock was 5% below the 10-day moving average, then I might get out when the stock closes above the 10-day moving average. So something simple like that. So whatever indicator you use to get in, using the same indicator to get you out. Or you can use another one too. But that tends to be the most popular and the best exit. At the end of the day, just doing that is the best exit. Everything else we're going to talk about, all the exits I'm going to now talk about, in general, they will reduce your returns and not necessarily reduce your drawdowns. But the reason I do some of these exits and the reason some of the people I advocate people doing some of these exits is these exits may make it such that you will continue to trade the strategy. And I think the biggest failure that most quant traders have is not that their strategy breaks, is that they stop trading it when it does poorly. And it will do poorly. It's guaranteed that at one time or another, your strategy will do poorly and it will have a drawdown as bad as you ever tested and probably worse. So anything that you can do that makes you keep trading it, to me, is a plus. Yeah.
And as Murphy dictates, it's probably just about to turn around just as you stop trading it.
Yes, it is. I can't tell you how many times that's happened to me. So the most common stop is your maximum loss stop. So it's like, okay, I don't want to lose more than 10% or 15% or whatever that number is. You can do it one of two ways. You could do it as volatility-based, or you can just do it straight percentage. In general, I've found if, I keep these quite far away such that they rarely get hit. Because most of the time, usually when they get, if you have them close, when they get hit is right about the time it's normally going to bounce. So I tend to do, as you probably can already guess, a fixed percentage stop. So I'll do something like a 15% max loss. And, I don't care about the volatility of the stock. But, again, if using a volatility-based max loss stop feels more comfortable for you, then that's what I would suggest. But understand, adding that max loss stop will reduce your returns.
Yep. Now, if I can just ask a little bit more about trying to define what that level is, do you include your stops in the back test, or do you do that afterwards? How do you fit that into the process?
I do it, in a sense, afterwards. After I've generated my back test, I kind of look at, okay, where's the catastrophic ones? And it's like, okay, very rarely do I get past 20%. Okay, let me just throw it at the 20% level or whatever level it is. So it's usually not something I test during the process because I know that it's going to reduce my drawdowns, and it's usually there just for purely comfort level. So it's usually at some level that only affects a small number of trades, and it's just like, okay, at what point am I going to cry uncle? The problem is 90% of the time, or not 90, but maybe 75% of the time, your big losses don't come from steady drips, but from overnight gap downs that your max loss won't help you with.
Do you ever take into account looking at maximum adverse excursion?
Right. I've done a little bit on that, but honestly, I've not done a lot. What little I've done didn't seem to be that I didn't seem to be getting anywhere, but honestly, I've not done that much research on using that idea.
All right, cool. So that was maximum loss stop. What other kinds of stops do you like to use?
So another common one, what I don't use at all, is a trailing stop. I have never, this is really funny, I've never managed to get a trailing stop to work on any of my strategies. And by any, I mean my breakout strategies, my trend following strategies, my mean reversion. Other people like them, kudos to them if they can figure out how to make it work. But I've yet to make a trailing stop work at all. If I put in a trailing stop in any of my strategies, it destroys the returns and works. I don't know. For some reason, I can't get it to work. Somebody else can figure out how to get them to work and tell me. I'd be greatly appreciated. But they don't work for me, and I don't use them. So that's unfortunately my story on trailing stops. So the next stop is the profit targets. This one I don't use at all in mean reversion. Again, I find for mean reversion, it tends to be better to let those bounces bounce. And profit targets tend to really cut back on your returns. So that's one that I don't, I have not had any success with that much.
So at the top, you mentioned the indicator-based exit. Are you waiting for it to close above or break that level? Is that how you're using an indicator as an exit?
Right. So let's say, if I'm using, let's say, the 2-period RSI, I may get in when it's under 10 and get out when it's over 70. Or if I'm using something like a moving average, I got in when it was 10% below the moving average, and I'll get out when it crosses above the moving average. So does that answer your question?
Yeah, so you're not actually putting like the moving average price into the profit target, but you're waiting for it to break that, and then you'll exit accordingly.
Yeah, basically, because at the end of the day, mean reversion trade is, a stretch down, and you're waiting for it to bounce up, and you're just looking for, that bounce up in some way to measure that bounce up.
Yeah. All right, cool. What other types of exits are there?
So this is actually one that I don't see that often, but it was one of my personal favorites, and I use it in quite a bit of my strategies, quite surprisingly so, is the bar exit. Meaning if I haven't gotten any exits, so normally I have an indicator-based exit, and I may have a max loss exit. That's pretty typical. But I will have a bar exit. And that means if neither one of those stops have been hit after, let's say, 10 days in the trade or 15 days of the trade, whatever number it is, then I just get out of the trade. That just tells me, the trade's not working out. This kind of exit, as all these other, things have done, tends to reduce your returns. But I also find I like this one because psychologically it's one of those, it really sucks to be sitting in a trade that's just not going anywhere or going down. So I've got one mean reversion strategy that I think it's after 9 days. I'll get out. If it hasn't bounced up to get my signal exit or it hasn't hit my max loss stop, I'm just getting out. And I find this exit works quite well psychologically to keep you in for those slow losers or the ones that just don't go anywhere and that are just sucking up capital. And you're like, you know what? This isn't going anywhere. Let me do something with it.
Yeah. Yeah. And what about using like a previous day's high as an exit?
Yeah, that's another common one. Using exceeding the previous day's high. Another interesting one, if you can, if you've got get execution, is just waiting for an up day. You'd be surprised, even just waiting for the stock to close up. That tends to work quite well. The problem with that is your edges are really small, so your execution needs to be really good to make that work.
Yeah. Okay, thanks, Cesar. Now, there's quite a few different types of exit techniques that you've just mentioned there. Now, what about when you want to combine them into a strategy? How do you choose the various combinations?
Right. So for myself, I tend to first test just using an indicator-based exit, and I'll find whatever parameters I really like, and then at that point I will test usually a max loss stop and a bar-based exits, just to see. Usually I will test and find values for those such that make it. I'm not looking to improve the system per se, but more just, what values will they not trigger that often, but make me feel comfortable that they're there and make me it likely that I will keep trading and won't pull my hair out. Well, I don't have any more hair, but so that's, those get added near the end.
Yeah. Okay. So when you're actually testing multiple exits, are you combining them all together to test the interactions, or do you test them individually first and see which is giving you the edge, or how do you actually manage that?
Yeah, so I first do the indicator. Once I found my indicator exit that I like, I'll test the max loss separately, the bar exit separately, and then I'll combine them and just see how they all work together. Is how I normally do it. But one could easily do them all, do them together. I don't test that many different values. Usually, it's I'll test like 3 values for each, and just see what it is. So it's real easy if I wanted to test them all together.
Okay, thanks. So just one more question now before we get into the audience questions, and that is scaling out. Do you ever look into scaling out a trade as well?
Yes, I've tried a couple of different methods. So the general idea is, the stock goes up, you get out of part of your position, and then you hold on to your other half of your position or other size of your position to hopefully get a bigger winner. I've tried, scaling out intraday. I've tried even exiting intraday. I've tried scaling out at the end of the day and waiting for much larger. And in general, I have found that scaling out has not helped the results at all. I've never traded any strategy where I scale out, a mean reversion strategy that I scale out on. So I've not, but like I said, if you find it more comfortable to use scaling out, that's great. But like I said, I've not found it useful for my own trading.
All right, so now let's start wrapping up with some quick closing questions.
Okay.
What's the biggest lesson that you've learned through mean reversion trading?
One of the biggest lesson I've learned, and I think I've mentioned this several times, is you have to be prepared for that. If you're trading the smaller stocks, Russell 3000 stocks or the Aussie stocks or anything like that, you got to be prepared to wake up one morning with a 50% loss or worse. That's just the name of the game. It's just much more likely to be happening. And, the first couple times that happens to you, it's really hard to deal with. Now, when it happens, I just roll my eyes and continue trading.
Yeah, it's just another one.
Yep.
Yeah. So, okay, this is probably linked actually. What's the hardest part of mean reversion trading?
I think it's the same as probably a lot of other trading in a different way, is placing the trades. Like I mentioned earlier, is sometimes you'll look at the chart and they'll be the ugliest looking charts. And you'll be going, why am I placing a trade on this? You'll look at the chart and it was down, the 3 days ago was down 5%. The day after that was down 10%. Today it's down, 8%. And now you want me to get in tomorrow? It's like, really? And it's like, okay, that to me is the hardest part of mean reversion trading.
Yeah. So what do you think is the most important ingredient to becoming a successful mean reversion trader?
A strong stomach.
Or don't look at the chart.
Yeah, I for a while I had a post-it on my monitor that just basically said, close your eyes and push the button. Yeah. Like you said, don't look. Just close your eyes and push the button.
Yeah, trust the model.
Yes.
Yeah. Okay, what about mean reversion trading books? What's your favorite?
So I've got 2. One of them is a book that I'm a co-author on with Larry Connors. It's called Short-Term Trading Strategies That Work. I like it. It gives you a really basic overview, and a lot of the steps that we've discussed here are covered in the book. Don't worry, I make absolutely zero for every sale from this book. So even if they see we sell a lot, I'm not making any money from it. And the other book I really like is from Howard Bound, MD. He's got lots of great books, and he's got one book that I think is literally called Mean Reversion Trading. That's also quite good. There are not that many books on mean reversion trading, quite surprisingly so. So those are the 2 I definitely would recommend.
Yeah. Okay, cool. And what's the best way for listeners to get in touch with you or to learn more from you?
Yeah, I mean, they can go to my website, Alvarez Quant Trading. I'm always posting blog posts like every 2 or 3 weeks. I love answering people's questions. So if your question didn't get answered here, you can, just go to my blog and send me your question through that.
Yep. Okay, awesome. All right, well, thanks so much for your time today, Cesar, and also in the previous session that we recorded. I really enjoyed this series, and I'm sure a lot of people are going to find it valuable. Now, is there anything else that you'd like to mention before we wrap up?
No, other than thank you so much again. It's always a pleasure to talk to you and to talk trading. I could talk hours about this stuff, and we kept these short, and like I said, I could talk hours.
Yeah, okay, cool. All right, well, thank you again for sharing all that with us, and it's also great chatting with you about trading as well. So thanks again, and I wish you all the best.
Thank you, and bye-bye.
Thanks, bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.